You already have the ability and the tools to be debt-free and mortgage-free within the next 10 years without changing anything in your spending compared to what you're doing now. What's up, Squares? Harold Perkins here, and yeah, that's right. You can own your home free and clear without changing anything in your budget. It's just that no one ever showed you how. Well, today, I'm going to tell you about a loan program that I think is just fantastic. And while the loan program may not be the proper fit for everybody, I think everybody should know about it. I'm a mortgage broker. Why would I tell you about a way to eliminate your mortgage?
Promised to help you, and still am, despite your constant mockery.
That's a common question. Of course, sometimes people are apprehensive about new things that come out of the mortgage industry. I understand that. But let's break down a few things first. First and foremost, we know that most people need to borrow money in order to purchase real estate. We also know that interest rates continue to be the predominant influence of decision making. To offset costs, especially when interest rates are high, borrowers tend to look for lengthier loan products. I would argue that even when interest rates are low, they still look for the longer loan terms.
What kind of mortgage did you get?
30-year total.
Oh, 30 years.
Okay.
Wow, you'll be paying this off in your mid-70s.
All right.
This is because most people's focus is actually based on the payment to determine whether or not the house is affordable. When people think about refinancing or financing real estate in general, their focus is on making the monthly obligation as affordable as possible, the lowest payment. As a result, the interest rate is the primary driver of their decisions, and they extend the term in order to make the monthly payment lower. But as you know, the longer you stay in debt, the more expensive that money becomes. Today, 9 out of 10 Americans uses the 30-year loan term to finance their house. Just look at the increase in home prices in the United States since 1965. It's estimated that it's increased over 118%, while income has only increased by 15% during that time. Not just housing affordability, but the affordability gap of all things has continued to widen. Mortgage debt now exceeds $12.5 trillion in the United States. That's just the principal amount outstanding on all residential real estate loans. That does not include the interest. If you were to add the interest owed, that number probably exceeds $20 trillion.
You're going to have to pay me $1 million.
The national retirement income deficit also continues to grow. This is the money that people need to have saved prior to retirement in order to live with the same standard of living after retirement. The total deficit is estimated to be between $3 and $4 trillion. This means that people are not saving enough for future needs. And you don't have to look too hard to see that the mortgage plays a big role in this. It's great that we have access to credit like we do in the US. It's a vital component to housing. There could not be the home sales that there are today without mortgages. But the mortgage debt itself impacts living affordability. Out of all the money spent to service household debt, over half of it is the mortgage. Traditional mortgages certainly have their place. We all have a period in life where the traditional mortgage is the most appropriate product. They create payment dependability. People are familiar with them. There is not much education that is necessary to understand how it works. It offers first-time homebuyers lower down payment options. So these traditional mortgages, like a 30-year fix, tend to benefit those who have a less established financial budget. But they can also set a lot of people back. Traditional mortgages are slow. Traditional mortgages are inefficient in the way they use money. They are a rigid financial product, and all of this leads to an expense that's hard to get rid of. Most people will spend their entire adult life paying for their home because of the mortgage. Let me give you some quick math. Let's say you're buying a house for $800,000, financing $640,000 at 6% interest. The total payment obligation over the life of the loan would be $1.3 million. That's over 57% more than what the cost of the house was when it was purchased. Of course, that's because of the mortgage. It comes with a lot of interest expense. At the time that I'm recording this video, relatively speaking, 6% is a great interest rate, but $741,000 of interest cost is a lot of money. In fact, it's 115% of the original principal balance of the loan. For every $100 borrowed, you would pay back $215 $15. That causes the cost of the house to be 57% higher than the price of the house. Well, that's why everybody's focused on the interest rate. Well, what if interest rates were lower? So in this example, if I use a 3% interest rate, it's still a lot of money, still over $331,000 in interest expense. It would still increase the cost of the house to be 34% over the price of the house. And we know that traditional mortgages are front-loaded with interest cost. This is the way they are, and this is the way they've been since the Great Depression era. Money flows only in one direction, and that's towards interest expense first. In fact, about 50% of the total interest charged on a 30-year fixed mortgage is collected during the first 10 years of the loan.
That number's so big it has a comma. Oh, wait, I left out a zero.
Listen, you. When you gave me that money, you said I wouldn't have to repay it till the future.
And we know that people tend to refinance or pay off or get a new mortgage about every 7 years. So people can end up stuck in that early portion of an amortization schedule, paying a lot of interest. The bottom line here is that low interest rate loans still charge a high amount of interest. When you take a step back and analyze what a loan is, all it is a mathematical equation with 3 parts. Interest rate always matters, but so does the principal balance, which is what the interest is calculated on, and so does the amount of time that someone will be in debt. But we've been programmed to focus solely on the interest rate of a mortgage. That's because people are driven towards payment affordability, and for good reason. But what if a lender just simply changed the equation, just changed the way the loan works, how money is applied? What if money was applied directly to the principal to reduce the amount owed, which then shortens the amount of time the homeowner would be in debt? Ultimately, that reduces the total cost obligation, which reduces the amount of interest you have to pay. And what that creates is payment affordability. And that's because the payment on this loan is constantly reducing, because it's designed to help people accelerate the pay down and pay off of their mortgage, lowers monthly and lifetime interest expense, and provides 24/7 access to home equity money. So it makes that process very comfortable, very safe, and very appealing. It accomplishes these things without refinancing once the loan is in place, and without a change in budget because most people can't cut back on their expenses today. Disposable income is being eroded away by inflation today. Most people can't just snap their fingers and instantly make more money.
I'll have some lemonade.
Certainly, that'll be $2.
But I've only got a quarter.
Then I guess you're going thirsty, loser.
And a budget change would disrupt your household lifestyle. So what if you didn't have to do that in order to save? And more importantly, what if you could save enormous amounts of money over time and accelerate the pay down of your mortgage and have access to your home equity money without having to rely on lower interest rates? What if you could accomplish all of this whether or not rates were low or high? And that's Galaxy's all-in-one loan. Here's how it works. The concept of Galaxy's all-in-one loan is the combination of mortgage financing and personal banking. When I say personal banking, I'm referring to an actual checking account. A checking account that comes secure with a Visa debit card, check writing, online banking and bill pay, mobile banking, external account linking, ACH transfers, wiring money anywhere internationally, customer service, and much, much more. The thing about checking accounts is we know that everyone has one. 100% of mortgage borrowers have and use a checking account regularly. So it's really sort of a commodity product that people already know how to use. But what most people don't know is that they probably flow more money through their checking account over the course of 5 years than they actually owe on their mortgage. Yeah, that's right. Most Americans will deposit and manage more money through their checking account over the course of 5 years than what they owe on their mortgage. And we know that the money is not spent out the very next day after you receive it. Money actually floats. It can sit idle in your bank account for days or weeks or even months before you have to spend it on bills and expenses. We know this because the US Census Bureau tracks consumer spending habits, and we have leveraged that understanding in our creation, development, and implementation of this loan. We don't go grocery shopping just once a month. That's a weekly event. We don't pay our cell phones weekly. That happens only once a month. So think about how much money just sits idle waiting to be spent. The problem with that scenario is that money sitting idle waiting to be spent earns almost 0% interest. Standard cash checking accounts earn very little interest compared to what we have to pay out in our debts, including our mortgage. So we've all heard people brag about their super low interest rate, but the thing about that super low interest rate is that it still costs more money than what your checking account is earning for you. And in that checking account is the cash that you need to keep on hand in order to make the monthly payment. So while we flow a lot of money through our checking accounts each month, it does very little for us in return. The traditional borrowing and banking process means that there's a barrier between your money and your mortgage and your other debts. Our money does not engage our debts very easily. So we send over a payment and the payment is amortized, so very little of it goes towards paying down the principal balance. Of course, most of that payment goes to the interest. But with Galaxy's all-in-one loan, we break down that barrier and connect the two accounts together. This connection is accomplished through a technology called sweep banking. What that means is when you deposit money into the loan checking account, that money does not sit there idle, waiting to be spent, earning you no interest. But instead, it's sent directly to the mortgage. Automatically, deposits are used to lower loan principal, daily loan principal. This saves you more interest on your loan than you could have earned by leaving that money in a traditional checking account. This savings begins automatically and immediately. That's achieved by the way the interest is calculated and charged on the loan. It's not amortized, it's not predetermined. In fact, it actually puts you in greater control.
Not some, all. Everything. Liquidated. Cash.
Interest is calculated nightly on the unpaid principal balance, and you get to control what the principal balance of that loan is. You can have it high, you can have it low, you can push any amount of money into it to reduce it, therefore offsetting or lowering your interest cost, and the interest is calculated nightly. Here's an example. If on day one your loan balance is $640,000 at 6% interest, the interest expense for that day would be $105.20. But what if you made a deposit the next day, driving the balance down to $630,000? That means the next day's interest expense is $103.56. This is what occurs ongoingly. As money is deposited and money is withdrawn for expenses, the interest calculation is done daily. At the end of the month, each day's interest expense is totaled, and that becomes your interest payment for that month. But the interest payment isn't due until the end of the next month, and the interest payment is automatically collected from the loan. So what I've just described to you is that Galaxy's all-in-one loan is designed to separate the principal repayment part of the process from the interest payment part of the process. What occurs here is that you will end the month with a lower balance than you started the month. This occurs naturally without any budget change. This is because you never make a principal and interest payment on the loan. What this loan does is it takes the money that normally would have been used as a principal and interest payment and converts it into 100% principal. We are very used to sending a monthly payment away every single month for most of our debts. It's principal and interest bundled together. And that process ultimately makes the interest cost invisible to most borrowers. You're aware that you're paying interest, but you don't exactly know how much you're paying. Galaxy's all-in-one loan makes everything visible and gives you greater control. Lowering interest payments means faster payoff and equity gain in the home. It's also money that remains available for use through all of the banking features. This is possible because it's a first lien home equity line of credit, or HELOC. This is what gives it all of the flexibility and control. It is the most flexible home equity loan in America, and it's structured very differently than a standard HELOC. One of those differences is that the established credit limit remains unchanged for the first 10 years. That means you can spend up to the credit limit. But after 10 years, the credit limit will begin to reduce automatically and evenly so that you get down to zero by the end of the 30th year. Anything between the daily loan balance and your credit limit remains available for you to use 24/7 all the way for the full 30 years. Now think of all the reasons and all the ways you could use this loan. Galaxy's all-in-one loan is intended for people who need more. Their lives are busy, they would love access to liquidity, they want more control of their finances, they want an easier way to save money. This just provides that. It's more than just the financing you need to purchase a home. It's a lifestyle loan. Traditional mortgages are designed to only use a small portion of your income to make the payment. Galaxy's all-in-one loan is designed to let all of your income work for you. This is the reason the paydown is accelerated, along with any additional residual income that's left at the end of the month. People that qualify for a home loan usually don't overdraft their checking account. They tend to have some amount of money in their checking account on any given day. So that money that wasn't needed for bills and expenses that month also gets applied to the principal balance of the mortgage. But it remains available for future use. It keeps your principal balance lower for longer. That saves you on interest. After 4 months, the principal balance is reducing dramatically. What's achieved in 4 months in Galaxy's all-in-one loan would take 12 months in a traditional 30-year fixed. And that traditional 30-year loan does not keep your money liquid. Long-term results are dramatic. It's mind-blowing when you realize how much money you can save, how powerful your income is. You actually already have all the tools it takes to do better, to save more, to reduce your time in debt, reduce the burdens, reduce the headaches. You have everything you need except the right mortgage product. All you have to do is put it in place. I've seen many scenarios where the homeowner was able to pay off their mortgage in 4 years, and all of this without changing any of their regular spending habits. Now, this loan is not for everybody. If you're somebody that's not comfortable managing your budget or your expenses are more than your income, then this loan is not for you. But if you want to take control of your mortgage interest and make your hard-earned money work for you so that you can become debt-free and mortgage-free faster than you ever imagined, then give me a call or message me for more information about Galaxy's all-in-one loan. One of our licensed and certified mortgage loan originators will show you a simulation and projections specifically based on your budget. They'll show you exactly how much you could save and how fast you could pay off your mortgage. This could be the last mortgage you need for the rest of your life. Later, nerds.